So we are discussing about analysis of long-term assets. Okay. So we have already discussed about assets when we were doing the chapter balance sheet, whereby we were checking about all the elements of balance sheet. So if I take long-term assets, I will divide this into two parts: tangible, intangible. Tangible assets are something which has physical substance. Intangible assets do not have no physical substance. The examples of tangible assets are property, plant and equipment, and intangible assets are like patents. Physical substances, you can touch this, you can physically see that like it is existing. These are all in more often documented forms. So patents, trademarks, copyright, franchisee, etc. So these are all the examples. Now coming to any standard, just a second. So IFRS, IAS, International Accounting Standards, and US GAAP. There are these two types of standards. So International Accounting Standard 16 deals with property, plant, and equipment. US GAAP, I really don't remember that code. And IAS 32 deals with intangible assets, because these are easy to remember. US GAAP codes are not that easy to remember. Okay. And coming to uh, like uh, yeah, coming to what does these standards guide you? The standards guide you about how to recognize something as a tangible or something as a asset. Okay. So recognition criteria, measurement basis, disclosure requirements. These are the three things every standard deals with. Okay. So when it comes to recognizing something as an asset, it should satisfy with the definition of asset, and we have already discussed many times about the definition of asset, right? Something which gives economic benefits and whose cost can be measured reliably. So these two, if they can give us economic benefits and their cost can be measured reliably, can definitely be shown as assets in the SOFP or balance sheet. How to measure them? Initially at cost, both of them I'm covering at once. Initially at cost both, and subsequently revaluation model. And this is only from the perspective of International Accounting Standard. US GAAP has a different treatment. US GAAP tells only at cost. US GAAP tells only at cost. Okay. Just give me a second. Excuse me. Give me a second. So initially at cost and subsequently revaluation model only in the case of International Accounting Standard 16. Fine. And in US GAAP only at cost. Cost is nothing but historical cost, and every year you have to deduct the asset value by subtracting the accumulated depreciation. Okay, and here also initially at cost, subsequently at revaluation model, if you are showing at cost, the treatment goes in the same way. You have to reduce every year the accumulated depreciation amount from the asset value, which is a shadow account of this non current asset. Okay, and shadow account is nothing but it's like, I can say it's a contra asset account. Contra asset account is nothing but it reduces the value of the asset. Coming to, if you're going with revaluation model, in case of revaluation model, you may like show the value of the asset at revalued amount. That means, let's say you have called a professional valuer for valuing your asset, and the valuer has valued the asset, and the valuer has, has given the revalued amount of the asset. Okay, and let's say the asset was, when you bought the asset it was $100,000, and you just remove the you have deducted the depreciation of $10,000, 10%, 90,000 is the asset value, and now in the market the value of the asset is 120,000. It's a revaluation gain. So this revaluation gain of 30,000 goes in other comprehensive income section. I already have discussed and explained you why, because non-realizable nature incomes go in the other comprehensive income section. Okay, now coming to revaluation model, there can be a reversal of revaluation gain or reversal of impairment loss. Now coming to what is impairment loss, this is the book value, I can say carrying amount. This is the carrying amount, and this is the amount which you are getting in the market. I will tell this as a recoverable amount. I will call it as a recoverable amount. Recoverable amount is nothing but it is higher of 2. I don't think that much detail is given to you, so I'll check it out and then only I'll explain you. Otherwise, I won't explain. Impairments, yeah, okay, recoverable amount. Yeah, okay, greater of, okay, I'll just explain it. Yeah, it's there. Yeah, so recoverable amount is nothing but higher of NRV, net realizable value, and value in use. Now, what is net realizable value? Net realizable value is nothing but selling price minus cost of disposal. Selling price minus cost of disposal is the NRV. You wanted to sell an asset at some price, and then you are incurring some cost or some expenses towards the sale of that asset. Nothing but you have to pay commission to an agent, and then if 100,000 is the value of the asset and 10,000 you are paying as commission, so 90,000 comes out as NRV. So NRV and value in use is nothing but the present value of future cash flows from this asset. That means this particular asset which you are holding, you will be utilizing that asset for generating some revenue in the future. So some revenue will be generated in the future in form of cash flows. You will be getting that amount, and those future cash flows you will be discounting with some required rate of return what you have, and then you'll be getting present value of future cash flows. That will be nothing but value in use. So let's say that is 80,000. So in these two case, the higher amount is 90,000, which is your recoverable amount. Okay, and now here the recoverable amount was 120. The recoverable amount was 120. So like 90 was the cost and 120 is the recoverable amount. Your carrying amount is less than recoverable amount. That means you're getting more, and in the balance sheet you're showing less. So there is a gain. You're getting gain, and that gain is revaluation gain or surplus, which will go in the OCI section. But let's say your carrying amount is 90,000 and your recoverable amount is 80,000. So there is a loss. and that is nothing but the impairment loss, and impairment loss will go in SOPL, statement of profit or loss, as an expense. And simultaneously, now onwards, if you are using revaluation model, if there's a gain, the asset value will be shown as 120 in the balance sheet, and if it's an impairment loss, the asset value will be shown as 80,000 in the balance sheet. And now onwards, the depreciation will be always on the revalued amount. Okay, so I have covered a lot of things now. Now next, coming to the cost. So I have explained you what models, but what is this cost of the asset all about? So cost of the asset is nothing but the purchase price, what you are like paying to buy the asset. Okay, purchase cost I can say, or the cost you are incurring for constructing the asset. Cost of constructing the asset. Okay, so purchase cost or cost of constructing the asset, plus if there is a purchase cost, you have to add freight charges. So I will tell you a basic concept. All such kind of charges which you are incurring only in the initial stages, that is at the acquisition of that particular asset, and bringing that asset from your supplier to your godown or your factory premise, and you will be spending only once those kind of cost during the initial stages. These are not of recurring nature expenses. These are all capital nature expenses, should be capitalized. So freight charges, any kind of taxes if you have paid, any kind of duties. Okay, and all these things should be added, and installation expenses, legal expenses, that means for transferring the asset to your name. So all these things you have to capitalize to the asset value and show in the statement of financial position or balance sheet. Okay, now so installation expenses and all. So this is all like you have to show in the SOFP, point number 1. So what I have covered, I have covered everything, and only I have to cover regarding the tangible assets is the disclosure requirements and also the treatment for reversal of impairment losses or reversal of revaluation gain. And let's discuss that, and then move in like we'll discuss about the intangible assets. The entire subject will be covered up, and then we will be going in and going into the main thing, like some important points they have discussed. We'll discuss that. Okay, now next point. Coming to cost. Yeah, now coming to reversal of impairment loss or revaluation surplus. Let's say you have bought a land is an appreciable asset, right? There is no depreciation for this, so the land value has gone up to 120. You have shown the revaluation surplus in OCI section, and after showing that revaluation surplus in OCI section, you have also taken that in the statement of financial position under equity. All things have been discussed in the previous past. If you are not following, that's not great thing you're doing. Okay, so 20,000 we have to write, and this is a line item of equity, so we'll write as revaluation surplus in equity section as 20. But now what happens? This was due to the surge in demand. Now there's a slump. That means the value has gone down to 70. So here the asset value has increased. So the entry would be asset to revaluation surplus, the journal entry of 20. Now the value has gone. The previous surplus now has got reversed. Okay, there is a surplus and there is a reversal of that surplus. That means 20 what you added will now be not existing. That means this will not, because you are not selling the asset, you are holding the asset for longer period of time and you are maintaining it, and henceforth every year whatever changes happen, you have to account for it, because the shareholders want to know what is the status of their asset and how it has been treated, because everything what you're doing is for the shareholders, right? So now what happens, the 20 previous gain will now be reversed. Okay, so entry would be revaluation surplus to asset account of 20. The reversal has happened, and then there will be a impairment loss of extra 30, right? Because from 120 it has gone to 70, so 50 is the loss. So 20 reversal has happened and extra 30 is a loss. So impairment loss to asset, or you can write P&L to asset, 30. This is the entry, right? This was about the reversal of revaluation surplus. Now if I go for the other way around, impairment loss, let's say I have shown the asset for 100,000 and there's a slump in the value, it has gone to 70, there's a loss of 30. So I'll show impairment loss to asset 30. And you know, always any impairment loss, any kind of loss will always be shown in the SOPL. So I'll write SOPL in the bracket. Okay. See, this is from the perspective of international accounting standard, not from the perspective of US GAAP. So I haven't mentioned US GAAP till now in case of these reversals, because I will give you a note for that. Okay. Now coming to, now the asset has gone to 120, let's say, and now the previous loss which was there will be reversed. So it will be asset to impairment loss of 30. So asset value has gone up to 30, and there's the whatever loss was there, it has been removed, because now we have to show the treatment, right? And extra 20 goes to OCI as revaluation gain. So asset to revaluation surplus 20, right? So this is the treatment. So any excess gain or excess loss is what we are checking here. Fine. Now please tell me in chorus, did you understand all the treatments? If you want any repetition, I will do it right now. Come on, please tell me yes or no. I'm waiting for your answer. Hello.
Yes, sir.
Got it. Pawan and Isha.
Sir.
Got it.
Can you please explain the
reversal?
Yes, sir. Yes, sir.
Okay. So no problem, but reversal thing is okay. I have taken an example, right? This was the non-current asset what I had, land, and its value has gone up to 120. Again the value has gone to 70, and there is a loss of previously there was a gain of 20, which I showed as a, I have given the accounting treatment to that, revaluation surplus to asset to revaluation surplus 20. Okay, because there was a gain. So increase in the value of asset is debit and increase in the income is credit. Okay. And then what happened? There was a slump in the value. First there was a surge in the demand, so value has gone up. Then there's a slump, the value has gone down to 70 from 120. So previous gain of 20 will be reversed now. That's the reason why I'm writing revaluation surplus in the debit, because I showed it as an income. Now that doesn't exist because the value has gone down and asset value has gone down by 20. And then what we see, this gain has got reversed, because from 70 I have to move to 120. Isn't it so? So I showed a gain of 20 that is reversed. Fine. Sorry, I have to show as a loss, right? Sorry. So previously it was 120. I showed the gain, and now the value has gone down to 70. So from 120 it has gone to 70, and the loss is 50. So previous gain of 50 I am reversing here. That means I'm putting revaluation surplus in debit and asset in the credit, and excess loss, because out of 50, 20 has been reversed. Now there's an excess loss of 30. That excess loss again I have to record or account. So that excess loss is impairment loss to asset value. Increase in expense is debit, decrease in asset is credit, and I will show given this accounting treatment, and then impairment loss goes into SOPL. This is clear. This was in the case of when there's an increase and reversal of revaluation surplus. But you know, if there's a decrease from 120, the value has gone to 70. Let's say not 120, sorry. In second case, what we will do is, there is an impairment loss. First, the value has gone down to 70. So I have to show that impairment loss. So impairment loss to asset. Okay. But now the asset value has gone from 170 to 120. So previous loss of 30 will be reversed. So asset to impairment loss, I'll put 30, 30, and then excess gain of 20, because from 70 it has gone to 120. So previous 30 loss I have reversed, and excess gain of 20 will go in the revaluation surplus. So asset to revaluation surplus. Debit, the increase in asset value, and credit is nothing but the increase in the income. Okay. And according to the treatments will be given, and now onwards the asset will be shown at revalued value, and the depreciation will be calculated on revalued amounts only. Fine. Now, this was from the perspective of international accounting standard, US GAAP. US GAAP. See, in case of US GAAP, you should always show the asset at historical cost. And every year you have to deduct the accumulated depreciation. If the asset value goes up, that is not at all recognized. Such kind of increment in the value of asset is never recognized in US GAAP, but only the fall in the value, that is impairment loss, is recognized. And this goes in the P&L account. And third point is, there is no reversal kind of case here. No reversal. Fine. That's very clear. And now coming to methods of depreciation, what you're going to use for depreciating your assets: straight line method, diminishing balance method. Here, straight line method, double declining method. Okay. Double declining method is having combination of straight line and diminishing balance. Nothing but here in straight line method, if there's a if the depreciation value is 10,000, every year you will be deducting 10,000 from the asset value. Here, in case of double declining method, you will take 2 times of the straight line depreciation, that is 20, deducting from the asset value. Okay. And after deducting the value, let's say the asset value is 1 lakh and you are deducting 20 and you're getting 80. Now the depreciation of this 2 times, what will be the depreciation of this? See, I'm telling you, this is double declining method. Like the depreciation amount will be 2 times of straight line. That means if depreciation amount is some amount, you will be taking 2 times of that, not the straight line. Leave it, not the straight line. We will do an example, right? You'll get to understand that. 2 minutes. Yeah, I'm not seeing any kind of stuff related to double declining method. So why to discuss that if that is not there in your syllabus? We will check a question related to depreciation and understand that. They haven't given any such stuff. Just checking, 2 minutes. Depreciation. I'm not seeing any such kind of stuff, double declining method. But still, if you are curious to know, I'll explain, don't worry. See, let's say like if I have to take an example, in that case I'll put an example here. 100,000 is the asset value, depreciation rate is 10%, so you will be taking 20,000 of this. Next it is 80,000, right? Again, what is the depreciation for this? 8,000, but you'll be taking 16,000, and that way you'll be deducting. Did you understand? Hello? Hello? See,
No, no,
yeah,
sir.
see, yeah, asset value is 100,000. The depreciation is 10%. 10% of 100,000 is 10,000, but I'm taking double amount of that. 20,000. Now I deducted 20 from 1 lakh, I got 80. Now on 80, if I take 10%, it is 8,000, but I will take 2 times of that, 16,000, and deduct. I'll get 64,000. Now in the in next case, I'll be taking 10% of 64,000, that is 6,400, but double of that. What will be double of 64,000, 6,400? 128, right? So 12,800 I'll be deducting. So it will be going in this way, double declining method. It is a accelerated depreciation method. See what happens, the reason, you should be knowing the reason behind all this stuff. The clear reason behind all this stuff is, you know, when you use a car for your own personal purpose, you would be, depreciating your car at straight line method. But let's say you are using it for taxi use, you will be using that asset very much during its initial stages, because it's a new car as a taxi, and you can get maximum benefits from your new car. But as the years pass away and it reaches its, it almost, it has to become scrap in someday, right? So it has to touch that zero value. You would not be using that asset, or you'll not be getting the best service from that asset during its terminal life. That means when it reaches its terminal life or its end of the life. So during the initial stages, when you're using it very much, that means if at all you are going to your office and coming back to your home, so you travel 40 kilometers a day. But if you're using it for taxi, you'd be traveling 200 kilometers. 2 or 3 or 4 trips of airport is more than enough to make this, because usually airports are at the, like, on the outskirts of a city. So here double declining method is more applicable. This is only from the US GAAP's perspective. International accounting standard doesn't have any such kind of concept with them. Okay, that's what. And we'll not go that much deeper into depreciation. There are many methods. There is, like, like depletion method, more often used in mining, in the case of mining companies. Or there is production hour method, there is machine hour rate method. So yeah, there are a lot of methods, so I would not go into that detail, hence, since it is not given. Okay, let's do some couple of questions here. I'll give you a question right now, we'll solve regarding the impairment. So asset impairment, just read this question. So information related to equipment owned by brownfield company follows. Original cost is given, accumulated depreciation at date is given, expected future cash flows is given, fair value is given, value in use is given, selling cost is given, and these are all indications for you to find out the impairment loss. So what's the formula for impairment loss? If the carrying value or carrying amount of an asset is more than its recoverable amount, there's a impairment loss. So here the carrying amount you will get only after deducting the accumulated depreciation from original cost. So that is what we will calculate. So 800,000 is your carrying amount. Okay, I deducted this from this, and I have to compare this with my recoverable amount. So for recoverable amount, I have to compare my expected future cash flows, and then I have this, and then I have to find out the value. This is value in use. No, value in use is given here. So I have this. Fair value is given and less selling cost. That will give me NRV. So net realizable value is 790 minus 30. It gives you 760. This is my net realizable value, and my value in use is 785. And I can see that my value in use, this is more than 760. That means in this both I can see this is more than this. So higher of this is my recoverable amount. So my recoverable amount has come around to 785. And if I see the difference, I am showing this as more and this is less. My impairment loss comes around 15,000, and this will go to SOPL. Okay, you can check this out. We'll move forward. Hopefully everyone is following. Yeah, that's great. If you're done with, I'll move forward. Try to understand. Okay, let's move forward. Now coming to US GAAP. US GAAP has a different version. This was from the perspective of International Accounting Standard or IFRS, whatever you want you can say. In US GAAP, the asset is impaired because first you have to check the, first you have to do the test of impairment. Yeah, yes, that is this is somewhat a different kind of scenario here. If you want more knowledge about this, I'll send you a video of US GAAP whereby I have calculated the impairment loss, and you can get an idea. So under US GAAP, the asset is impaired because first there should be a test of recoverability test. That's the reason why they have given you two values here. So you must have seen that they have given you value in use and expected future cash flows. So expected future cash flows is relevant in the case of US GAAP. See what I'll be doing right now. Henceforth, the amount will differ. Okay, this is the important change you need to remember. First, you have to go for the recoverability test. What does the recoverability test say? So your expected future values of are 795. Okay, what you are expecting from the asset is to be 795, and you are showing 800,000 in your books. This is the book value. I'm not using carrying amount. Carrying amount is generally used for IFRS book value. See, you have to recover this book value, right? But are you able to recover this book value? No, you are getting what? Less. Please tell me yes or no. Yes or no?
Yes, sir.
Yeah, you have not been able to recover this value. Your expected future cash flows are less. That means from the asset, whatever the future expected cash flows you wanted, that is not able to give you the entire value of the asset. So this is what you have. So recoverability test has been passed. Now we understood that we are not able to recover the assets value. So there is a impairment loss which has to be calculated now. Second step is calculation of impairment loss. Now in case of calculation of impairment loss, what will you do? You will just take your fair value. Nothing, no treatment, nothing you have to take. You have to just take your fair value, not net realizable value. So fair value is 790. And the carrying amount is 800,000. So you are showing more, you are getting less. So 10,000 is the impairment loss. Any doubt you can ask me right now and clarify which goes to SOPL or P&L account. Okay, just check this out.
So why are we taking fair value?
Sorry.
Why are we taking fair value 790,000?
Fair value. No, this is not the fair value. This
No,
is the
790,000.
expected future cash flow. Sorry.
Uh, in the second part, why are we taking 790,000?
Yeah, they consider fair value. They are comparing the book value with the market value or fair value, not realizable value. Different school of thought, right? Different way of taking the things.
Yes.
Yeah. Now, if you don't get any, if you are yourself able to sell that asset without any expenses, then what is the case of taking that expenses and deducting it from the market value of the asset? So they say that show the market value directly. Okay. Don't deduct that from the asset value. Because however at times this is a part and parcel of like the trade. Sometimes you may hire an agent and sometimes you may not. So they have their own reasons of explaining all that. So that's a rule based system. So what they say we have to follow. It is their way of taking things into consideration. They don't take realizable value, they take only fair value, market value. This is what is CFA, why the CFA course is very good courses. You get a comparative study of both the standards. Otherwise, if you study US GAAP, you won't be asking such questions because I would be putting things on the screen or board and I'll be explaining you. And of course, like what is there in the curriculum, we have to follow, right? See, accounting is not about all science. It's not like it's not a subject which is like science, which has cause and effect and all principles, etc. This is more of rule based system. Double entry rules you have, right? Do you have principles? Yes. What I'm asking, Bhargav?
Yes, sir.
Bhargav, I'm asking something. Double entry, rules of double entry. See, I'll ask you a question. Why always we put expense on debit? Why should we put expense on debit? Why not on credit? Do you have an answer for this?
So it's because as it says, we have to do it.
Yeah, that's what. No answer for such questions because this is the rule. We have to follow that rule. Based upon that, concepts have been built. Okay. Shall we move forward now? Anything else you want to discuss in this? Shall we move forward? Yes. Okay. We'll do one more question right now. See, I am telling you, focus much on your theory aspect, your concepts. They are giving more theory questions nowadays, and students are not able to crack the exam Don't expect practical problems. Build your concepts very strongly. Every exam I am hearing the same thing these days. More theory questions. What is the depreciation method? Question we saw, right? Yeah. Now we'll do a question calculating average age and total useful life. See, both the standards we have covered, only disclosure requirements are there and something we have to discuss. See, at the end of 2008, a company has gross property, plant and equipment of $3 million and accumulated depreciation $1 million. This is gross, we have to net it. During the year, the depreciation expense was $500,000. What's the average age, total useful life and remaining useful life of the company's PPE? See the formula for average age. See, first of all, you should know the formula for depreciation expense is nothing but original cost minus scrap value by useful life. Correct? Is it right? Hello. So original cost is historical cost as well. If there is no scrap value, you have to keep it zero. So if I take there and bring this here, so useful life is equal to historical cost by depreciation. This is done. So what is your historical cost of the asset? $3 million. What is the depreciation expense? $500,000. So it is 6 years. Total useful life is 6 years. Now, what is the average age? So there's a formula for average age. Accumulated depreciation by annual depreciation expense. See, accumulated depreciation is nothing but every year depreciation you are accumulating the amount of depreciation. Let's say 50,000 is what I have accumulated and my annual depreciation is 10,000. So my average age will be 5 years. Is it right? Yes. Come on. Something I am getting no answers. Average age is what? 5 years. On an average, the asset has been used for 5 years. So here the question is. The question says, what is the accumulated depreciation you have? It is $1 million. And what's the depreciation expense you have? $500,000. So you have 2 years. Average life is 2 years. Formula for remaining useful life. That means now how much depreciation has been removed and how much the asset has to be still used. So the formula here, ending net property, plant and equipment. So let's say you have used the asset for 5 years, so you'll be getting an ending value at the end of the 5th year. Divide by annual depreciation expense will tell us still how many years the asset is to be used. Okay, so in this case we have ending net PPE. So how we'll get ending net PPE? So 2008's like gross PPE is 3 million. We'll remove the accumulated depreciation. We'll get the ending net value divided by depreciation expense. It has still 4 years. Okay, that means the total useful life is 6 years. Average life the asset has been used is 2 years and it still has how many years? 4 years of remaining life. Remaining life, total useful life and average age. Fine. Please go through this. All of you are following. After finishing, tell me, I'll move forward. Yes. Done?
Yes.
Hello.
Yes, sir. Done.
Yes, sir.
Okay. So last part of this, I think we have done all the concepts related to property, plant and equipment with respect to US GAAP and IFRS. Now only disclosure requirements. See, what is this disclosure requirements all about? See, you have to give extra. See, I will cover up everything. Don't worry. When you read the text today, there will be some topics which will be left over. Don't worry about that. Every topic will be covered. How much I have explained today, you only focus on that. So by tomorrow, I think next class, I will close this. Disclosure requirements. Only I have to cover up intangible assets. Okay, I think almost I have covered that in the previous chapter, class, and I have only some ratios. How the ratios will be affected? Ratios will be affected because of treatments we have to check. Disclosure requirements, nothing but additional information about the asset you have to put into the footnotes that you always like you make after preparing your financial reports. That means what method you are using, from where you bought the asset, from whom you bought the asset, what's the value of the asset when you bought it, what's the method of depreciation you're using to depreciate it, what's the useful life of the asset, what's the average life, what's the ending life. Have you made any additions to asset? Have you done any kind of improvements to asset? What extra you have spent? Okay, any kind of revaluation gain in case of IFRS or international accounting standards, any revaluation gain has happened, you have to put it. Any kind of reversal of revaluation gain, any impairment loss, any kind of reversal of impairment loss, all things have to be disclosed. Fine. And a reconciliation, like from how much you bought the asset for, and what the value you are showing today, as on today, at the end of this particular year, when you close your balance sheet or your books, you have to put all this extra information, because you can't put that on the face of the financial statements, right? So this all comes under disclosure requirements. And tomorrow we'll discuss about asset held for sale purpose, when we will be showing the asset as held for sale purpose. And also we haven't discussed about sale of asset and profit from sale of asset, profit or loss from sale of asset. So I am planning to explain those concepts tomorrow, like at once. If I, okay, it's like very simple to explain. I will explain right now. Let's say you have bought an asset for $100,000, and the depreciation for accumulated depreciation of the asset is 50,000 for 5 years. Now the asset is of 50,000. After deducting the depreciation, you are selling the asset for 70. You are making a gain of 20. So this gain, what you're making of 20,000, is profit on sale of asset, which you will be putting in the SOPL, and any loss also goes into SOPL. Fine. Loss is in the case when 50,000 worth of asset you're selling for 30,000. See, now you'll be asking a question, sir, then this is impairment loss, right? See, impairment loss and revaluation gain is only applicable when you're holding the asset till its maturity. That means maturity is nothing but till its useful life, the whole useful life. You don't have the intention to sell the asset in midway, but when you sell it, you get the money in your hands. It's a realizable nature income, has to be recorded in the statement of profit or loss. Any loss in the statement of profit or loss. Fine. That is 20 loss. This is all about the tangible assets. Totally, I have explained everything. Tomorrow I'll discuss about intangible and close this chapter. Fine. Thank you. Because if I continue still, I think I want a lot of time to finish this lecture. So I'm leaving 5 minutes before. Tomorrow, if it takes more time even, I'll cover up and finish it off. Okay. Thank you, all of you. Yeah, thank you. Thank you. I'll just tell the time tomorrow, what time I'll be taking, and I'll be closing this chapter. Fine. And giving the PDF to you. Thank you. Bye.